What is good, YouTube? It's your boy Only Trader, and we're back with another video. We're just gonna quickly run through the Candlestick Trading Bible. I hope for most of y'all that have been engaged in this series, I hope you've gotten something out of it, and I hope you've gone on to look for your own copy of the book. With that being said, I just want to run through this. As you can see, we don't have much left of it to reach 268 pages, so that's the plan, and from there on new content will be coming out, and probably along with that new content we're gonna have another book that's gonna help with our mindset and our strategy. With that being said, let's get straight into the video. And with this video we're gonna start off with the engulfing bear candlestick pattern. So the engulfing bar pattern, sorry about that. The engulfing bar pattern is one of the most powerful and profitable price action patterns. Knowing how to use it properly as an entry signal will tremendously improve your trading profitability. In this section, you will learn how to use the engulfing bar pattern profitably. It doesn't matter if you're a beginner or advanced trader. If you're looking for a seriously better trading strategy more than what you've been using, you have come to the right place. So what's an engulfing bar pattern? This reversal candlestick pattern consists of two opposite color bodies in which the second body engulfs or covers entirely the first one. And as you can see below, we have a clear illustration of that right here. So that will be your engulfing, sorry about that. That'll be your engulfing bar pattern. And you can see you've got two variations of it. This is a bullish engulfing bar pattern, and clearly this is a bearish engulfing bar pattern, and the common theme among these patterns is that one candle completely consumes the other candle by like maybe 2 or 3 times its size, and that is an identification for an engulfing pattern. A bullish engulfing pattern forms at the end of a downtrend. It provides a clear signal that the buying pressure is overwhelmed by the selling pressure. So, in other words, the buyers are now involved. A bearish engulfing pattern occurs at the end of an uptrend, and it is a top trend reversal indicator. It shows that bulls are no more in control of the market, and the price trend is likely to reverse. See the illustration below? And as you can see, we clearly have price creating lower lows in a downtrend, lower lows, lower high, lower low, lower high, lower low, lower high, lower low, lower high, up until it gets to the bottom of the downtrend and the bullish engulfing pattern occurs, and this is the confirmation for the reversal that price is about to start moving the opposite direction. And if you are in a trade taking sales at that point, it will also be an indicator to show you that maybe it's time to exit your trade, and if you can still take profits from it, secure your profits, close the rest in your loss. A bearish engulfing bar, according to Stephen Nyson, the father of modern candlestick charting, this candle must meet 3 important criteria to be considered as a reversal pattern. The market is clearly in a definable uptrend or downtrend. The engulfing candle comprises of 2 candlesticks, and the first body is entirely engulfed by the second one. The second row body is the opposite of the first row body. So as you can see how we just have price was in an uptrend. It was starting to move up until this bearish engulfing pattern formed here, and that began a little bit of a range and then a reversal, and you can see that there's a bit of a choppy market. It's ranging a bit. So how to trade the engulfing bar price action signals. So to trade profitably this chart candlestick pattern, you need to respect 3 important elements. Number 1, the trend. If you look at any chart, you'll notice that there are times where the market is moving clearly in one direction, in times where it is moving sideways. To be honest, trading the engulfing bar pattern with the trend is the easiest way to make money in the market. You don't need to be highly knowledgeable about technical analysis to determine whether the market is trending or not. Make a stupid symbol. If the market is making a series of higher highs and higher lows, it is about an uptrend. And if it's making a series of lower highs and lower lows, it's simply a downtrend. Nothing more, nothing less, nothing complicated. And if you cannot see it making any of those things, it's ranging or it's choppy, which means you shouldn't trade it because you can't really identify the direction that it's moving in. So the illustration above shows a clear uptrend. You don't need to use an indicator to determine whether the market is trending or not. Just look, which, as we can see, the price was coming down. He plotted his trend line right here and it respected the trend line, and it went back over here. As you can see, bullish engulfing pattern occurs, creates a high, creates a low, creates a higher high, a higher low, a higher high, higher low, higher high, higher low, clearly showing that price is bullish right now and the price is moving up. That's the direction of the trend. So at your chart, try to apply the concept of higher highs and higher lows and vice versa. When you're analyzing your charts, bear in mind that the markets move in trends, and trading with the trend is the most important element in your technical analysis. There's no more important than the trend. Don't never try to fight or control it, otherwise you'll pay the price expensively. You can make money under any market conditions, no matter how powerful your trading system is. You have to be patient enough and let the market tell you which direction it's going in. Successful traders say the trend is your friend, and if you're on a master trading the engulfing bar pattern, your first rule is to follow the market direction. In other words, the trend should be your best friend. And now we go to number 2, the level. When you find a clearly definable uptrend or downtrend, the next step is to identify the most important levels in the market. I mean the most powerful support and resistance. If price tests a support level and stop, this is an indication that buyers are there, and this area is watched by all participants in the market because it represents a great buying opportunity. Conversely, if price tests a resistance level and stops in an uptrend, this is a clear signal that selling strength is in the market. The example below shows you how the participants interact with support and resistance levels. These levels are different forms such as trend lines, channels, flags, triangles, key levels, etc., and your ability to identify them in your chart will help you find better price levels in the market. In trading markets, when price passes through resistance level, that resistance could become support. See the illustration below to understand how to trade the engulfing bar pattern with support and resistance in a bullish or bearish downtrend. So as you can see here, we've got our levels of resistance where we saw multiple wick rejections, multiple touches at certain areas, and these became our major resistance levels. In between, you can see prices constantly creating supports and resistance, but we usually tend to concentrate where we've seen that it's come to that level maybe 2 to 3 times, no less than once, 2 to 3 times. And in this case, it's coming out 1, 2, 3, 4, 5 times. And this level came 1, 2, 3. And these are the key levels. These are what we identify as key support and resistance levels. The minor levels will be found in between, but most of the times you want to be trading from these levels because these are usually the tops and the bottoms of the movement. So here again, as you can see, we have another key resistance where price touched it once, twice, third time. So usually the parameter for a key level is that price reach that level at least 2 to 3 times. So these levels take different forms, such as trend lines, key levels, support and resistance, triangles, channels. There's so many ways to plot your support and resistance, and along the line I'll be dropping a video just to show you the different types of support and resistance that can be used, and from there you can identify which one is best for you and for your trading strategy. So there are other technical tools that can help us find the best levels in the market, such as supply and demand zones, moving averages, and Fibonacci retracement ratios, which can also be used as a form of support and resistance. The moving average, you can use it the same way that you would use the trend line, in anticipating that every time that price bounces off according to your trading plan, that's where you should probably be executing your play. So as you can see, our price was in an uptrend, creating higher highs, higher lows. It approached this resistance level, broke through, closed above, came back to retest it. Engulfing bar occurred, clearly showing that price was not gonna return back to this level, and instead kept going up in the direction that the pattern informed us of. So that's basically the concept of how you try to identify the pattern as a reversal. So the signal here is an engulfing bar pattern. You can apply the same rules when trading the inside bar candlestick pattern. Your ability to identify an engulfing candlestick at a key level in a clear uptrend or downtrend will greatly enhance the probabilities of making a winning trade. So here's another example below where we pretty much have the same thing, and we see that this became a major resistance due to the fact that it touched once, twice, and 3 times here, and managed to break above, with price closing above these previous candles and the previous highs, which really indicates bullish movement. Price did its dance, came back to retest, and on that retest a bullish engulfing pattern was formed, which identifies that price is most likely to continue moving up and not sideways. And in this case, you'd always like to have your stop loss below structure, let's say about here. Give it a few pips below structure for it to have room to breathe, because you will see price come back down just as it did here, and then eventually continue in the direction that it's meant to go in due to all the confirmations. Trading the engulfing bar with moving averages. Trading the engulfing bar pattern with moving averages provides a very profitable trading strategy. However, the lack of knowledge about using the moving average can damage dramatically your trading account. Traders use moving averages in different ways: as a trend following tool to identify the direction of the trend, so they buy the market when prices are above 200 simple MA, and they sell the market when it's below 200 simple MA. To determine whether the market is overbought or oversold, we just watch how prices interact with the averages. For example, in an uptrend, if price moves far from the moving averages, this is an indication that the market is overbought. To predict the trend, change by using the crossover strategy. If the moving average crosses over another, it is a signal of a trend reversal. As any trading system, the moving averages have disadvantages. This is why you have to know how to use it successfully under the right conditions. This trading technical tool doesn't apply to all markets. Don't ever try to use it in a range bound or untradable market, because you'll get a lot of false signals and you'll definitely blow your account. So the thing with the moving averages is that it's an indicator, meaning that it's priced in after price has actually done what it had to do. So it's always a delayed reaction, but nevertheless, when you use it in Confluence with price action and reading market structure, it's just going to be an added confirmation for you to be more confident in the ability to take your trade. Don't let it hinder you from taking trades. To the best of my knowledge, using the moving average as a dynamic support and resistance in trending markets in combination with an engulfing bar strategy is the perfect way to make money in the market. The strategy is very simple. We'll use the 21 and the 8 simple moving averages in the daily and 4 hour time frames, and we'll define a clear bullish or bearish market, and we simply buy when price pulls back to the moving average and an engulfing bar pattern forms. See the illustration below. So clearly you can see that price is in an uptrend due to the fact that it created higher lows, it created higher highs, came to test the resistance, came back down, came to test the resistance again, came back down again, came for the third time to take the resistance and to close above and eventually push up before a minor pullback towards the moving average, and that's where our bullish engulfing pattern formed. And another good confirmation for this is that this price closed above this minor resistance, meaning that most likely price is going to continue upwards. And from there on it just continued up, retesting a bit, pulling back a bit, continuing up, pulling back a bit across the moving average, but nevertheless it continued in its direction up until it got to its highs, broke the moving averages, and began a reversal. Conversely, if the moving average is trending down, it shows that the market is in a downtrend. We saw when price retraces to the moving average. The screenshot below shows how prices interact with the moving average as dynamic resistance level and how the engulfing bar pattern represented a high probability setup. So as you can see from the chart below, the price was clearly in a downtrend, creating lower lows, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. And along this, clearly, as you can see, we're using the 21 moving average as our dynamic support and resistance. And in this case, the 8 moving average is simply just a tool to identify the direction in which the market is moving. And as you can see, every single time it came to touch and then pull back, it came to touch and then pull back every time it got to the moving average. So how to trade the engulfing bar with Fibonacci retracement. Traders use Fibonacci retracement in different ways. However, the most important retracement levels are the 50% and the 61% Fibonacci retracements. Knowing how to use this tool in conjunction with candlesticks will definitely maximize your profit potential. According to chart technicians, the most major moves retrace around 50 or 61% Fibonacci retracement. This knowledge will provide you with the ability to predict with high accuracy the next major move in a trending market. The strategy is very simple. You define a clear uptrend or downtrend, and then you define the major corrective levels by using Fibonacci retracement tool. If you see an engulfing bar pattern matches up with 50 or 61% levels, it's a powerful price action trading signal like we see in the chart below. Personally, I do not use Fibonacci, but I will try to break it down for you so that you can try garner an understanding of it. So as you can see, price was trending upwards, came to test the resistance, pulled back, broke above, closed above this resistance, and from there continued up, came to pull back, and it pulled back right onto the 6150 level and formed an engulfing bar pattern which is your confirmation that it's time to take the trade. From this, you can also kind of see it created a miniature double bottom pattern. That would be another confluence for you. And eventually price continue moving up, even though most traders in this case would have thought that maybe it was moving down. But don't forget that this resistance became a support. So don't be afraid, because you know that there was a resistance here. So you just got to look left and realize that no, this is actually support. So when you see something like this happening, don't start trying to take sells, because there is a support here, and the support was clearly formed right here, which means that price is going to continue moving up, because the support is only going to help it move up and not down. In the example above, the engulfing bar price action signal matches up with the 50 and 61% Fibonacci retracement level. The resistance level that becomes support is another confirmation to take this high probability setup. This trading strategy is very powerful, and here's another example. So as you can see, we've got price in a downtrend, creating lower lows and lower highs, and we have a resistance level, we have a support level here, and price clearly breaks below the support, closing above the support. I'm sure here this must have been the weekend, because there's a gap here, but nevertheless price continued moving downwards through the weekend, and from there on it came back down, created a double bottom pattern here, which is a very powerful pattern that indicates a reversal. And from there price came back up, back to its resistance, where it aligned with the 50 and 61, not forgetting that this was a support that has now become a resistance, due to the fact that we have the candle closing below here, and we have price moving down and coming back to retest, but never actually breaking or closing above this level, meaning that this has now become a major resistance level, in conjunction with the Fibonacci, and right here an engulfing bar pattern, indicating that price is is going to make a reversal and continue downwards in the direction that it was initially going in, because as you can see, price was moving down the whole time. So trading the market from 50 and 61% levels means you're trading for better price levels. As a result, you'll put as many probabilities in your favor as possible, and that will allow you to become one of the most successful traders. And as you can see from my illustration, there were a lot of indicators that showed bearish movement and a lot of confirmations that you could have used. But nevertheless, nothing is guaranteed in the markets, so always protect your capital. So trading the engulfing bar with trend lines. Trend lines give traders an idea about the psychology of the market, especially the psychology between buyers and sellers. Moreover, it allows professional traders to determine whether the market is pessimistic or optimistic. This technical trading tool is used in different ways, either as support and resistance by drawing them horizontally, or to identify price and time by drawing trend lines vertically. There is no wrong way in using trend lines. In trading markets, we use simple trend lines to highlight a trend by connecting swing highs or swing lows in price. This way helps us find high probability entry setups in line with the general trend of the market. So as you can see, we have our trend line here, and the common thing with the trend line is that we are trying to touch all the highs to determine the trend, which you can see we've touched all the higher lows in this case, because we are moving downwards, creating lower lows, lower highs, lower lows, lower high, lower low, lower high, lower low, lower high, lower low, and there we plot our trend line, trying to touch as many lower highs as we can to determine the trend and to plot our trend lines accurately. So by connecting the extreme highs, we had a trend line that acted as a resistance level and the formation of the engulfing bar pattern shows a good selling opportunity. If you use just horizontal support and resistance levels, you will miss this profitable trade. Learning about how to draw trend lines is never a bad idea because it's the simplest analytical tool that you can use to analyze financial markets, and it works in all markets, whether it's forex, commodities, futures, stocks, crypto, indices, index 500, whatever the fuck it is. Trend lines are your friend. That trend is your friend, man. So now we have another depiction of the trend line, and as you can see from this, we are in a bullish market, and we plot our trend lines trying to get as many touches to the extremes of the market. So in this case, we're looking at the extreme lows in an uptrend. So we have price creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and we only identify the trend line at the extremes where it comes to touch. So as you can see from here, this was an extreme, this was an extreme, this was an extreme, this is an extreme. So these are the areas that we should be looking to plot our trend lines. We don't want to see you plotting a trend line in this area because that just doesn't make sense. It's not going with the structure of the market. But in this case, it's going with the structure of the market. So your trend line should always be on the outer edge of the candlestick chart at the extreme higher lows or lower highs. So in this case, these will be lower highs. And in the case above from our previous example, this will be the higher lows. So just know that if it's in a downtrend, we are looking for the higher lows to plot our trend line. And if it's in an uptrend, we are looking for the higher lows to plot our trend line. We don't plot them on this side, we plot them on this side. So just remember that, and you will never get stuck with your trend lines. And remember that it's at the extremes of it. So the chart above shows a bullish trend. The trend line acts as a support level with the price action signal that occurred created a great buying opportunity. So how to trade the engulfing bar in a sideways market? One of the most difficult markets to predict can be the sideways ranging market. I always recommend traders to focus on trading trending markets, but the problem is that the market spends more than 70% of the time in ranging motion, which means you'll end up waiting a lot just to get your perfect setup, and you might miss out on potential buying and selling opportunities. If you focus just on trending markets, you'll probably leave a lot of money on the table. This is the reason why learning how to approach range-bound markets is a must if you want to make a decent living trading financial markets. What is a range-bound market? When the market stops making high highs and high lows in the case of an uptrend, or higher or lower highs and lower lows in the case of a downtrend, the price starts acting between specific high price and low price. This is a clear signal that the market is ranging and no longer trending. It's just going up and down, up, down, creating resistance, creating support levels. And we know that when price does this, it's most likely going to be in anticipation for a big move, because think of it as a battery that is just charging up constantly, plugged in on the charger, and it's just charging up, and at some point it's going to want to burst and release all that energy, which in this case it ended up releasing that energy here, and you'll most likely see that this will be a crazy move. So as you see in the example above, the market is trendless. It is trading between horizontal support and resistance, and you can't apply the same techniques that you use in the trending market to trade engulfing bar patterns in range-bound markets. Let me give you an example. When you're driving your car, you don't always drive the same way. If you're driving downtown, you try to drive slowly because you know that that driving faster can put your life and other people's lives in danger. But when you're driving in a highway, your driving style changes completely because you know that you can drive fast. So you always try to adapt your driving style to the appropriate situation. You have to do the same thing when you're trading the engulfing bar pattern. Because all price action strategies we discussed before will not work in range bound markets, and you have to use the right techniques that fit these market conditions before talking about the right way to trade trendless markets. You have to be selective about trading range bound markets to protect your capital. Because not all sideways markets are worth trading, you have to know the difference between sideways and choppy markets. And at the same time, you always have to identify the range of the trade that you're trying to take, meaning that if you see that that potential trade can only get 5 to 6 pips, then there's no point in taking that trade because your risk is always going to be more than your potential profits, and we don't do that. Minimum we look for is 10 pips going on. So here we have an example of a choppy market where it was going up and now we just don't know what's going on. Yeah, we just don't know what's going on. Is it creating higher highs, higher lows? Nobody knows. It's not even ranging properly. So as illustrated above, the market trades in a crazy way. We can't identify major support levels and resistance. You have to stay away from these type of markets, otherwise you will definitely damage your trading account. Trading the engulfing bar candle in range bound markets is very simple. The first strategy is going to be about trading this price action pattern from major support and resistance levels like we see below. Sorry about that, guys. Sorry about that. Got a bit too carried away, yeah. So as you can see here, price created a high and it created a major low. And from there on, price continued to do its dance within these two parameters, meaning that this is a range. Got our support and resistance here, and our engulfing bar pattern, which you can take trades in these markets and make quick profits, but these are trades that most likely you will need to scalp instead of, you know, making a whole swing trade out of this, or a trade that's gonna last a day or 2 days or however long. These should be short trades that are taken within your session where you manage your trades on site and you make sure that you collect your 10 pips and leave your runner running with your stops at break even. So the second strategy is to trade the breakout of the range or to wait for the pullback. See the illustration below. So here we have a resistance level, a false breakout, an engulfing bar, and that is our confirmation to take the trade. But as you can see, it's much more difficult when you don't really know which exact direction the market is moving. So for me personally, this would be the best area for you to come and take a trade because you know that this was a major support level and you've seen price break out, close below, come back to retest it, and we've seen the retest so many times, and that's where your pattern occurs. Now you know that price has this resistance, so it's going to be much more difficult, and you can place your stops above the structure, meaning that you're most likely safe from any potential pullbacks. And from there on, price continues to move down in a big move. And as you can see, it went down, 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 up until it went down to this point and created reversal. Because from this point, it was just building energy, energy, and was waiting to release it. So false breakouts are one of the most powerful price action strategies. It occurs in all types of markets, and if you know how to use it in combination with the engulfing bar pattern and a major support level or resistance level, you'll make money in the market because you'll buy intelligently the bottoms and sell the tops. So these are the false breakouts at a resistance level, and basically that's the same chart as the one above. Trading the engulfing bar with supply and demand zones. Supply and demand areas are more powerful than support and resistance. It is the place where banks and institutions are buying and selling in the market. If you can identify these turning points, you'll make a difference in your trading account. To trade the engulfing bar pattern successfully with supply and demand areas, you have to be able to identify quality supply and demand levels on a chart, and according to the Candlestick Trading Bible's experience, there are three factors that define quality supply and demand areas. 1. The strength of the move. Oh my gosh. 1. The strength of the move. Pay more attention to the way that the price leaves the zone. If the market leaves the area quickly, this is an indication that banks and institutions are there. 2. Good profit zone. You have to make sure that the level provides a good risk to reward. 3. Bigger time frames. The daily and 4-hour supply and demand areas are the most powerful zones in the market. The chart below shows a quality supply area. As you can see, the move is very strong, and that indicates that banks and institutions were there. The formation of an engulfing bar is a clear signal that the bears are still willing to sell from the same price level. So as you can see, this will be our supply area. And for me, I would identify this as a key level. So we'd like to make trades from the key levels, because usually when you make a trade from the key level, it does not come back to that level and it goes to the next key level. Nevertheless, we always manage our trades and we stick to our risk management, but we like to take trades at key levels due to the directional bias that it gives us as traders, and that, that confidence that price will continue in that direction, due to the fact that large institutions are making trades at those levels. So as you can see, we have a strong area here, a supply area, and from here we have price closing below this resistance. So this would be a good opportunity to take a trade, to take it downwards, secure your pips, and as you can see, it came straight to the next key level before doing a reversal. So you will be trying to catch the moves in between these key levels. You'd be trying to take trades from here in anticipation that they will go down to the next key level. If you're getting into the market at this time, you'll try to take a trade here in anticipation that it'll go back to the next key level, and so forth and so forth. So I think that it's not complicated to identify these zones because they are characterized by strong moves. The secret behind supply and demand areas is that big players put their pending orders there when the market approaches these zones, and we see a crazy move from these levels. At the end of this video, I'll suggest to you another video where you can see how I identify my key levels. So if you can combine trading supply and demand areas with the engulfing bar price action signal, you'll increase your chances to make money as a trader. And with that being said, man, this is Only Traders, where I'm going to continue to provide you guys with content. I hope you guys can bear with me on the quality, on my delivery, everything. I hope you can just stay and witness the journey and be a part of it as a community. I hope to work with many of you out there, even though right now we haven't spoken. Just bear with me, stay with this. New content is going to be coming up, but let's just finish this off. And from there on, you can always go back to this and revise it, and I'll throw in another video at the end where it'll show you how to identify the key levels or the supply and demand zones. With that being said, peace and love. This is Only Traders. I love you guys. Stay safe. Protect your capital.